This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi everyone, and welcome to the latest episode of the AJ Bell Money and Markets podcast. I'm Charlene Young, and joining me today is our very own Danni Hewson. Hi Danni.
Hi Charlene, we are here to bring you the latest news and insights from the world of finance, kicking off with more on the Bank of England's interest rate cut last week and how the FTSE 100 reached new highs despite tariff woes.
We've seen results from McDonald's giving us plenty to chew over. I'm so sorry, I couldn't resist that one. An activist investor building a stake in BP, and Elon Musk sniffing around OpenAI and making a bid for the company he co-founded.
It's okay. I was talking about Coca-Cola earlier and using lots of fizz references. So, chewing over is perfectly fine. Our interview this week is with Foxtons CEO Guy Gittens, who chats to Dan Coatsworth about what's happening with the London property market, issues for people renting and lifetime ISA usage. Plus, Tom Sieber from Shares Magazine will be here to talk about defensive stocks. What identifies defensiveness and what are those traditional defensive sectors?
So, Danni, as you covered last week in last week's episode, the Bank of England obviously cut the base rate to 4.5% last Thursday. We are recording this episode on Wednesday afternoon, nearly a week later. And how have markets reacted to something that was, fair to say, largely priced in, I think?
It was largely priced in. But what wasn't largely priced in was the expectation of more additional rate cuts this year. Now, going from thinking maybe two rate cuts, now they're thinking possibly four. I mean, we could be down to 3.5% on the base rate by the end of the year. So what did that do? As you say, that cut, the first cut, the one that happened last week, was largely priced in. But the expectation of further cuts, I don't think was. We saw the pound fall against the dollar, though it has steadied since, but still low at $1.24, which of course is great for all those companies that make money in dollars and then convert to pounds. It also lifted a lot of the rate-sensitive stocks. So, things like house builders, all those consumer-facing retail stocks. And what it did altogether was lift the FTSE 100 to record high after record high. I mean, it was only a few weeks ago that we were remarking on the fact that the blue chip index had broken that psychological 8,600 barrier. It doesn't feel like it was that long ago. It wasn't that long ago. Well, after the Monetary Policy Committee decision, it lifted past 8,700 and it's well on its way to 8,800. Currently today, pretty flat around the 8,778 mark. Now, we have had in the last couple of hours fresh inflation data out of the United States, and CPI came in slightly hotter than had been expected. So all of that sort of cementing the idea that the Fed won't cut interest rate cuts in a hurry. In fact, we had testimony from Jerome Powell earlier this week, the chair of the Federal Reserve. He was effectively saying, look, we're not in any hurry. And what was very interesting, because, of course, in amongst all of this talk about rate cuts and the economy, because we do need to say that one of the reasons for those increased expectation of Bank of England rate cuts is because the Bank of England has also lowered growth expectation. I mean, it had been talking about 1.5% GDP growth over the year, slash that by half to 0.75%, which is not a good number when you consider that the government is all about growth. But the one thing Jerome Powell didn't do was specifically address the elephant in the room, which, of course, is tariffs. We can't get through a podcast without talking about Donald Trump and his tariff threats. They keep shifting. Volatile is how markets have been because markets just can't get a handle on where they're going to go next. And the last lot of tariffs, of course, which were introduced were the 25% tariffs on aluminium and steel. It's already had Canada and the EU coming out and saying that they will retaliate because, US is a huge consumer, a huge importer of steel. In terms of British steel, how much UK steel is exported to the United States, it only accounts for about 10% of all the UK steel exports, but a lot of it is speciality steel. And the last time we had these tariffs, actually, a lot of companies were still buying the speciality steel. They were prepared to pay those extra tariffs because they couldn't make it themselves. So that's probably one of the reasons that the UK, Douglas Alexander, hasn't waded in and said anything about tariffs just yet, sort of in a bit of a holding pattern, although, of course, there are concerns that potentially that could mean that the UK is flooded with cheap steel if it isn't heading over to the United States. But yeah, I mean, all in all, we've seen the FTSE 100 year to date, it's up 7.4%. Now, we've been talking about US markets being an outlier for a good few years. But when you look at the S&P 500, it's up just 3.18%, and the NASDAQ up just 1.72%. Now, of course, AI has played into that. We've got DeepSeek. We've got, obviously, these tariffs and the expectations that they are likely to be inflationary for the United States. But certainly, this is a great picture for the FTSE 100. FTSE 250 also up, but I think probably tempered by these growth expectations. It is nowhere near the highs that we saw post-COVID. Still got an awfully long way to go before it hits that mark. So a lot of this is probably more outward looking than inward looking. But yeah, I mean, it's certainly nice to see the FTSE 100 having this run of good form.
Yeah, definitely kind of makes a change. And kind of on the mortgage side of things, we've seen that kind of starting gun fired on mortgage deals too, which is hopefully welcome news for people who've watched rates stay incredibly sticky and actually in some cases rise despite, the base rate cuts or the expectation of base rate cuts. So kind of Santander was the first of these big lenders to dip under the 4% mark with fixed rate deals. So it's actually launched 2 and 5 year fixed rate mortgages at 3.99% for borrowers who have a 60% loan to value ratio. These deals do come with quite high fees though, just under £2,000, £1,999 for home buyers and £1,749 for people remortgaging. Barclays, it's worth mentioning, has also introduced similar 5 year fixed rate mortgage deal at 3.99%. Although that comes with an £899 fee. Now, we also need to mention first-time buyers, obviously typically going to have higher loan-to-value ratios, and they are still facing challenges with rates in this space being still higher than they were at the start of this year. And, that's despite actually more choice of these products coming in than ever really for this group. But that extra choice isn't necessarily leading to kind of much better deals, which will be really disappointing for people looking to complete, particularly before the stamp duty hike at the end of March. It's still early days. Like I say, it's not even a full week since the cut was announced. And as we know, mortgage rates follow the swap market. And like I say, the base rate itself was only cut last week, but lenders, I think they're really going to want to see some action to back up the calls that we've seen for lending rules to first-time buyers in particular to be relaxed. I think, it's not trickling through to better deals in this area. So, in a nutshell, while the base rate prompted some lenders to offer some more competitive mortgage rates, the impact on individual borrowers is going to depend on your specific circumstances and the kind of type of mortgage that you're seeking.
I, for one, am keeping a really close eye on this because I have to confess that my mortgage deal, which was a 5-year fix, so I was incredibly lucky. I've never had a 5-year fix before. I don't know what made me do it, but I'm so glad I did. And it comes to an end at the end of the year. So I'm just watching these rates like a hawk. And yeah, I have to say, I'll get to 6 months out and I'll be like, I'm going to try and lock in just in case, because I'm incredibly nervous. But you've said that, we sort of haven't seen it really start to properly filter through. And there's been a lot of expectation of, mortgage wars. But there's also been a lot of expectation that all this talk about relaxing house building regulation would give house builders a massive lift. And we just haven't really seen that in the share price until the last day, because we had the first set of results since the autumn acquisition of Redrow by Barratt Developments, and we saw shares jump 6%. They were at the top of the FTSE 100 index, and shareholders seemed to be really encouraged by what they were hearing from Barratt Redrow, reporting some recovery in customer demand. We've seen really solid activity since the start of January, looking at their figures. And the company is now expecting that profits are going to be towards the upper end of market expectation. So, of course, that has really cheered up the city. And they've also liked the fact that the recovery in operating margins with this enlarged group look much healthier. So we're seeing them go to 15% from 7.2%, and the expectation that it will deliver about 22,000 homes a year in the medium term. So we had some share buybacks off the back of that. And it really sort of cheered markets, and house builders were a beneficiary of that interest rate cut from the Bank of England. We saw all of them jumping off the back of that news. But certainly this lot of results from Barratt Redrow has really given the sector a lift, because it has been under pressure. It's been interesting to watch.
Yeah, and kind of moving on to more results and company updates. We've had full year results from both BP and McDonald's. And I think, interesting times at the former, with an activist investor taking a stake. And, with McDonald's missing some of the earnings targets analysts were after, but both of them seeing rise in share prices off the back of the results. Is that right, Danni?
Well, BP's share price actually rose most significantly the day before its results and really hung in there, despite the fact that, well, I think it's fair to say they were a fairly torrid set of results. I mean, a slump in profits to the lowest level since the pandemic. And investors, and I think this is fair to say, have become increasingly frustrated, because you've got this valuation gap now between BP and Shell, which of course is its London-listed rival. And also when you look towards those US energy giants, ExxonMobil and Chevron, I mean, it's like night and day. And a lot of investors have taken a look at the diverging strategy of these big oil giants. BP, under Bernard Looney, who left because he failed to disclose relationships with some of his employees, he had a real green strategy. And the new boss has been under huge pressure to roll back on that in order to capitalise on what is expected to be continued demand for oil and gas for a considerable period of time. And we've seen lots of the rivals like Shell and Equinor really scaling back and increasing oil and gas production. We know that Shell's already doubled down on fossil fuels under its chief executive. And when you take a look at the share price of Shell and BP over the past 5 years, Shell share prices are up 33% over 5 years. BP's have fallen 3%. So we are now expecting on the 26th of February, this strategy to be abandoned. And the company is now under increased pressure and increased scrutiny, because activist shareholder, well-known activist shareholder, we've discussed them a lot on this podcast, Eliott Management, have come in and they've bought a stake in BP and going to push for more investment in oil and gas, and an anticipated change to the board. What we saw with the numbers was effectively, fodder, manure to cultivate this change in strategy. And there has also been expectation that potentially one thing that could happen is that BP could merge or be gobbled up by a bigger rival. So, yeah, I think we're going to have to keep a close eye on that and see whether or not BP's strategy, when it announces it in a couple of weeks, sort of staves off these calls for bigger changes. McDonald's, plenty to chew over, as you said. It was interesting because on the one hand, if you look at sales in the US and the UK, I mean, it wasn't great. It wasn't great at all. You're talking about falls to sort of COVID levels. But overall, it saw a pretty decent jump up. So I think it was 0.4% increase in sales globally versus a 1.4% dip in the United States. Some of that came from a bit of a rebound in China and Japan. Some of it came from the Middle East. So we've spoken on this podcast before about the fact that McDonald's was being boycotted by some in the Middle East because of what was going on between Israel and what was happening in Gaza. And I think as things have eased off a little there, although, it's a very tumultuous part of the world, and it's never far from the news, but there's been less boycotting happening, so sales have picked up there. And in the US, I think one of the reasons that investors were prepared to sort of look beyond that sales dip in the US is because we had this E. coli outbreak in the last quarter. So they'd stopped selling quarter pounders temporarily to, deal with the outbreak. I think one thing that we do need to think of in terms of McDonald's is that it is really appealing to families, to the value end of the market, to people who've been really struggling with their budgets. It's doubled down on its value offer, those meal deals and Happy Meals. You go in and you can buy a meal for a family of 4 and get change for 20 quid. That's the sort of area it's been trying to focus on. But that, of course, does impact margins. But ultimately, if it can keep people coming through the doors to buy those value meals, the expectation is, and certainly something that they're seeing, is that people will start to add on those extras. And that's really where they'll start to make the money.
Thanks, Danni. And, it would not be the Million Markets pod without a bit of AI chat, although on a slightly different note this time to previous or recent episodes. So the world's richest man, Elon Musk, wants to make a bid, or has made a bid, I should say, for the company he once helped set up, although quite a bit has happened since then.
Yes. I mean, Elon Musk, you would think that he's just way too busy to be wading in here. I mean, where does he find his time? From the Oval Office? Yes, he's always in the Oval Office. He's always on X. And clearly he has a bit of a bone to pick, a score to settle with Sam Altmann. I mean, they set OpenAI together. And then they had a bit of a falling out. Elon Musk left the company. And the idea with OpenAI was that it was open source. It was supposed to be AI for the good of humanity, not for profit. And what's happened in the sort of last year or so is that OpenAI and Sam Altmann and the board have said, look, in order to advance, we're going to have to make it a for-profit company because we need the cash in order to create these advances, which will then benefit humanity. But that then begs the question, when they switch from this non-profit to a for-profit, what's the company worth? How much does the for-profit pay for it? And there had been sort of figures, really lowball figures of around 40 billion, whereas latest valuations I've seen, the kicking around the last couple of days, is about 300 billion, particularly because of this Stargate project that Donald Trump, the president, has sort of got in mind with OpenAI. So Elon Musk, devil making, has put in this offer. Now, on the one hand, you could think it's just Elon Musk being Elon Musk. So he's offered to buy OpenAI for $97.4 billion. So significantly more than a lot of discussions were that OpenAI was looking to buy itself, but significantly under the valuation. But what it does do is it sort of focuses the minds about how much OpenAI, the profit bit, is going to pay for the whole company. So it puts Sam Altmann in quite an uncomfortable position. But I've really enjoyed the exchanges on X. And in response to the offer by Elon Musk, Sam Altmann came out on X saying, no, thank you, but we will buy Twitter for $9.74 billion if you want.
I saw
round it down.
This exchange. And I think I saw Sam Altmann being interviewed in Paris and, getting things slightly personal, saying, I think he's just a sad man or he's getting quite yeah,
these tech bros, they are getting incredibly nasty, I think. It is getting personal. But there was something really important in some of these exchanges. And I think that this is something which will definitely be discussed in Paris and I think needs to be discussed generally. And that is about who do we want responsible for the growth of AI, to take it forward, to protect the company, but also to, nurture it through what is effectively a teething stage. And there are still huge questions about its potential, but also its potential pitfalls as well. So, this long-running feud has been funny, but I do think that when we're talking about AI safety, when it is controlled as it is at the moment by so few billionaires, you have to feel slightly uncomfortable.
Yeah, interesting times indeed. Now, before we bring in Tom Sieber, I just wanted to talk about something new and shiny. No new handbags or cars for me, sadly, but we have just launched a brand new podcast series under the AJ Bell Money and Markets umbrella. So it's led by our head of investment analysis, Laith Calaf, and the deep dive series is going to bring you longer podcast episodes on the money and market topics and themes that we think you'll love. So we've just got the first episode in the can for release on Monday, and it's looking at all things tax and tax planning. So I joined Laith to take a look at the backdrop of the tax burden in the UK and what tools are out there to help you plan your personal finances as tax efficiently as possible. We've even got an interview with the Deputy Director of the Institute for Fiscal Studies. All very exciting in my opinion. I mean, I am absolutely into that kind of thing. So yes, please give it a listen if you are interested. Now, next up, as I said, we've got Tom Sieber, editor of Shares Magazine. If you're not already aware, this weekly magazine is available free of charge to all AJ Bell customers. So Tom is going to walk us through all things defensive stocks. Over to you, Tom.
Thank you, Charlene, and thanks for having me. Yes, that's right. So among sort of a number of topics we covered in the magazine this week's issue, including a lot of the things that you've been talking about on the podcast, we did an article looking at defensive stocks. So I think it's a term probably you hear quite a lot, but perhaps isn't kind of often fully explained. And particularly, at the moment, the market backdrop is quite uncertain. We've obviously had, the volatility in the tech sector recently. We've got all the stuff around Trump and tariffs. And in this article, we looked to sort of try and quantify what a defensive stock is. So to give you kind of in a nutshell, obviously, if you read the article, you'll be able to get more detail on this. But defensive companies are companies that aren't too closely tied to the economic or market cycle. So the opposite of a defensive company might be like an oil company or a mining company where they move about depending on global commodity prices, which are heavily affected by what's happening in the underlying economy. Whereas, if you look at, an obvious example of a defensive sector would be, say, the pharmaceutical sector, where generally people, need medicine regardless of what's going on in the economy. So these businesses don't tend to have their demand dictated as much by what is happening in the economy. And one of the areas where this article sort of tries to define what a defensive stock is by looking at something called beta. And don't worry, I'm not going to get too technical with it, but essentially the concept is that if a stock has a beta of 1 or less, if it has a beta of 1, it would move exactly in line with the market. If it has a beta less than 1, then when the market moves by a certain amount, this stock will move less than that. And if it has a beta more than 1, then it'll move more than that. So it'll be more kind of volatile in the market. So in some sense, in one way of kind of defining what a defensive stock is a stock that is low beta and therefore isn't going to move around as much when the market moves around.
Oh, yeah. Tom mentioning beta there, you're taking me back to my studying days and modern portfolio theory. So tell us a little bit more for listeners about defensive stocks. What kind of the classic names and, a few more sectors. I know you've already mentioned sort of healthcare there.
Yeah, so healthcare, obviously the one that I mentioned. Another area traditionally that has been seen as defensive is tobacco, which obviously, for some people, there might be ethical considerations around investing in that area, but it is often seen as a defensive because demand is relatively sort of inelastic. So, there are two sort of fairly large, substantial tobacco companies listed in London, which are Imperial Tobacco and British American Tobacco. And they, as the article sort of details, they are lower beta than the market. So they are low beta names. Other areas, things like utilities, where, there's a regulator that basically sets the terms of how much money they can make. So their earnings are pretty predictable through the cycle. So that's another area where, traditionally it's been seen as defensive, but, I think that's an example which shows that companies or sectors don't necessarily remain defensive indefinitely, because obviously we've seen, particularly in the water utility space, that, those businesses have run into trouble more recently and certainly wouldn't have been all that defensive for investors looking to sort of protect themselves from downsides in a portfolio. So I think, there are traditional defensive sectors, but it does change over time. I think that's why kind of something like beta is quite useful, because there are names that you wouldn't necessarily expect that are quite low beta. So in the article, we look at a company called Halma, which does a lot of work. It's an industrial stock, but it does a lot of work that is related to kind of health and safety regulation. So that's, again, it's something that's not driven by what's happening in the wider economy. That's what kind of lends that quite a sort of defensive status, I suppose.
Thank you, Tom. That was really interesting. Now everyone loves talking about property. We've got a double dose for you in this week's podcast. And who better to get an insight into the market than the boss of London's leading estate agent, Foxtons. Dan Coatsworth recently caught up with Guy Gittens to get his thoughts on where the property market could go next, the issues facing people who rent, and whether flaws in the lifetime ISA are causing issues for prospective buyers in London.
Well, I'm pleased to be joined by Guy Gittens, the Chief Executive of Foxtons. So, Guy, thanks ever so much for coming on the podcast.
Thanks a lot for having me, Dan. Looking forward to our chat.
Yeah, I mean, I just thought I'd start with kind of what's going on with sort of the outlook for the UK property market. We had some figures out showing UK house prices were at a record high in January, but it does feel like the outlook's a little bit gloomy. The Bank of England's halved its economic forecast for the year. I'm just wondering, what's your thoughts about where the property market might go this year?
It's a really interesting question, and obviously I've spend a lot of time talking to our investors who are all city-based and very, very focused on the kind of macroeconomic outlook. But I also spend an awful lot of time in our front offices talking to our employees, and they are right at the very coalface of the property market for both sales and lettings. And of course, they're two entirely different markets there. 70% of our business is in reoccurring lettings revenue today. And that's been obviously a big strategic position over the last 2 or 3 years since I've returned back to the business. But if we look at sales, first of all, we're really optimistic. Obviously, today we have a small additional incentive for first-time buyers who are trying to beat the reduction or the removal of that stamp duty holiday that was introduced a few years ago. And ultimately, I think that movement is helping sales volumes today. I don't think it's really helping the average sales price that we're seeing, particularly across London, because of course that activity is taking place in a much lower position than what perhaps the average sales price might be across London. But it's definitely a small added incentive. But even if you remove that activity for that particular tranche of buyers, we've seen a lot of activity returning back to the market as we've seen incremental smaller reductions in the interest rates, and obviously what that means for mortgage rates for people over the last few years. And the market was in this state of recovery, should we call it, after 2022 and the mini budget in September. We had a period of about 6 months directly after that period, after that shock interest rate rise, where the market really was in a little bit of paralysis. And I think it's very understandable that when people's mortgage rates or the quoted mortgage rates that people are paying have gone from 1.5% suddenly overnight to closer to 6 or 6.5%, it takes a long time for people to really adjust their expectations on where those mortgage rates might be. And that has happened over time. And of course, over that time, we've also seen a couple of rate drops. And each time we see a rate drop, we see more buyers coming back into the market. And really, the buoyant position that we are seeing the London market in at the moment is, I think, as a result of quite a few more people returning back to the market who perhaps would have put their property search off for a year or for a year and a half, 18 months, and are just now starting to filter back into the market. And if you look at one of the big lead indicators that we look at, obviously we're London's largest estate agency brand, so we have more data on this than anybody, and we really get incredible insight to seeing what's happening in the market, whether that be 3, 6 months or even 9 or 12 months in front. We get to see the volume of new applicants that are registering each day. We look at what that means for viewing numbers. We then look at the uplift in offer numbers and then offer accepted, and what that bid offer spread looks like. And we look at one of maybe 200 KPIs going through that chain to give us an insight as to what the next what the period ahead looks like. And I suppose one of the biggest forward indicators to our future revenue or the future sales volumes is looking at the under offer sales pipeline. And actually at Foxtons, the under offer sales pipeline is at its highest point since before the Brexit vote in 2016. So I think that gives you a really good feeling for where the market is. And we're very optimistic, but that might not be shared by some more economic focused, city focused individuals. But for the property market, we know this is going to be a better year than 2024, which was a much better year than 2023. And just to put that into round numbers, I suppose, just to finish off that piece, is in 23, there was an all-time low number of transactions in London. That was approximately 80,000 transactions. We've only ever seen that number once before, which was at the global financial crisis. In 2024, that number increased to somewhere between 85 to 88,000 transactions. We think this year will be somewhere between 90 to 95,000 transactions, but that's still considerably below the kind of 5 to 10 year average, which is more like 100,000 transactions. So it certainly won't be a runaway year, but much better than the 2 prior years that we've seen. But I don't expect to see a lot of price tension. I think because there's a lot of property on the market, there's some good appetite, but I don't think we'll see huge price increases across the year.
What about on the letting side of things? Obviously, there's always sort of these alarming stories in the media about people queuing up ages to view a property, offering above the asking price just to secure this flat or house that they want. Is that just a London thing, or is that broader across the country? And what might be causing that?
Yeah, it's definitely a UK-wide issue, and certainly the whole dynamics of the market before COVID happened were very, very predictable in lettings for many, many years. And you could look at the overall value of what we call the private rented sector. It's had very, very steady long-term growth that's extremely predictable. That's the wonderful thing about our lettings business is, it's super predictable. We know exactly, what we expect to see coming back as reoccurring in revenue, what proportion of each end of tenancy will renew and therefore become another new tenancy. So it really is, for us, it's a really beautiful, fascinating business because of the way that income works. And that's why we've focused so much of our time and effort on making sure that we're delivering organic growth in lettings as well as obviously growing through acquisitions as we have done. But the lettings dynamics changed immeasurably when the whole of the UK was coming out of COVID. And that really upset the balance of supply and demand. And really that the market has taken a long time to try to rebalance coming out of that scenario. We had a change of people's lifestyles. We had, at one period going into COVID, we had lots of available stock here in London coming to the market. Our stock levels went through the roof as people were either moving back in with parents or downsizing, moving out of London, as nobody really knew what the year ahead looked like. And then all of a sudden we had this huge release where almost, if you look at the market, we saw nearly 2 years worth of tenants returning back into London in a very, very short space of time. And what that meant is that the available stock at that particular given time got absolutely decimated. So there was almost no available stock for this huge bulge of of tenants coming back into the market, and it made it very, very difficult for tenants to find properties. Obviously, as like any market, supply and demand dictates pricing, and we saw when there were multiple tenants trying to rent the same property, we saw people offering above to try to secure it, and that did affect over a short period of time that saw pricing move, and this was across the country. We saw pricing going up approximately 20% in the space of about 3 or 4 months. Not desirable for anybody. It's really not healthy for London. It's not healthy for the UK. We didn't welcome that in any way, shape or form. We'd much rather see a longer term, more sustainable lettings market, because that's the way it should be, and certainly makes it much harder for us to operate our business. Even thinking about the 1,500 employees that we have, finding it difficult to live in London because of the cost increases. But since 2021, when that big spike happened, the market is starting to normalize again. Last year, we saw very little price increase across the year, and I forecast that we'll see very little price tension again going across 2025, because the market's just still in a slight state of recovery. But as with anything, the UK needs, London needs to find a solution to delivering more lettings units, because that is what will ultimately provide more quality accommodation for tenants, which is what we all want, and temper those moments where we've seen this extreme price tension and the price increases happening.
I mean, there's talk that the government wants to ban upfront deposits for lettings. Do you think this would actually be a bad thing?
This is part of the government and part of the prior government's move to try to make renting fairer for tenants and make longer term tenancies more secure, which absolutely we're fully in support of. I think there are certain aspects of this that are very, very complicated and will have absolutely unintended consequences. And this upfront payment is a really hot topic at the moment. We've written to the government. There's a lot of coverage about this in lots of national press. We were picked up and talked about in the national press over the last week alone in the Times. And I think the reality is the lettings industry, while on paper might seem quite a simple process, it's extremely complicated and very, the processes that the relationships, the contracts are highly complicated areas of how the industry operates. And by making some of these changes, what is actually going to happen, it's going to make it harder for a certain proportion of the UK's tenants. It's going to make it harder for them to live in a property that they want to live in. And that's really the bottom line of why we're trying to highlight this issue to the government as quickly as possible, because this whole bill, the Renters Reform Bill, is being pushed through and accelerated as quickly as possible by the government. But of course, this is one of the areas that we are worried that will have these unintended consequences. And if we look at our own portfolio across London, we think it's somewhere in the region of 15% of our tenants today use some form of an upfront payment to be able to afford to live in a property that they want to live in. Whether that means that they can make the affordability formulas work so that they can live in a catchment area of the school that they want their children to go to, or that they want to live closer to the transport links so that they can get to work in a sensible time. All of these things, it is absolutely part of the makeup of the tenancy world today, and I think it could fall some issues if we don't take very, very serious approach to how it's been looked at. So yeah, we're working hopefully with government to try to highlight these issues, and hopefully we can find a sensible solution to it.
Okay. I mean, the government's obviously talking about encouraging changes to the planning system, encouraging house builders to build more properties. I mean, that would ultimately potentially create more properties for rental. But on the sort of the ownership side of things, obviously they've got a lifetime ISA where if you save into it, the government will give you a bonus on top, and it is designed to help people get on the property ladder. But the maximum you're allowed to buy is £450,000 property. Obviously, in London, even sort of things that first-time buyers would buy, quite often, they're now above that limit. I'm just wondering, what from your experience at Foxtons, what do you find that you've got some potential buyers and they realise actually they're going to be charged this 25% exit penalty because the property they want to buy is above £450,000. Therefore, they can't withdraw the money for their deposit without paying a penalty. Does that affect? Obviously, it must have a negative effect on potential transactions.
I think it's a really good point, and if the reality of how we see it is, there really isn't a huge volume of our first-time buyers who are talking about a lifetime ISA. And that's the reality. They're much more interested in trying to save up to £11,000 on a period of stamp duty holiday. That for them is much more real money in a scenario where overnight they might be in a position because of earnings or because of bonuses or whatever it is. Working life enables them to be able to get onto that ladder. The reality is, I don't think there's a huge uptick or uptake on that lifetime ISA as perhaps the government might think that there is, and we're certainly not seeing people pulling out of purchases because the affordability of that threshold of £450,000. But what we are certainly hopeful of is that there's some form of new incentive from the government, as we've had in the past from previous governments, to help and continue to help first-time buyers to get onto the ladder, and that's really, really important. Whether or not that's some form of help to buy scheme, which is obviously very, very popular over the previous period, or whether it be a renewed look at this stamp duty holiday for first-time buyers. All of these things are helping it become more affordable in a very, very expensive process. So yeah, that's probably our position on it.
Thanks to Guy for coming on the show. Well, that's all we've got time for today. And thank you so much for tuning in to the AJ Bell Money and Markets podcast. Please don't forget to subscribe and leave us a review. It is nearly Valentine's Day after all, so please feel free to share the love. I'll be back next week with Laith Khalaf and some very special guests. In the meantime, thank you for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.